Welcome to the Deep Dive. This week, we're really cutting through the noise, looking at the most critical developments in global transportation. This is for the week of August 4th to 10th, 2025.
That's right.
We've taken all the sources you provided, articles, research, our own notes, and we've basically distilled them down to give you the core insights you need fast.
Yeah, and our mission today is to really unpack how these three powerful forces are interacting. We're talking rising trade protectionism, persistent geopolitical instability, and then the really rapid acceleration of technology, especially AI and automation.
Okay.
How are these things fundamentally reshaping the way goods move around the world? And I think most importantly, what does it actually mean for you?
Okay, let's dive right in then. The global economy. It's presenting a really complex picture right now.
Yeah.
Growth is, well, uneven, and forecasts are being tweaked. Global GDP growth for 2025, for instance, is forecast slightly down to 2.42%. Global real exports are actually up a bit, 1.93%, but U.S. exports are down almost 2%. But what's really significant here, I think, is how policy decisions aren't just reflecting trade flows anymore. They're actively, almost aggressively, redirecting them.
That's a great way to put it. What's fascinating and maybe a bit concerning is just how pervasive this trade protectionism is becoming, especially, coming from the United States.
Right.
We saw new tariffs under Executive Order 14257 that gives the president pretty broad authority. They officially took effect August 7th.
Okay, so what kind of tariffs are we talking about?
Well, pretty substantial ones like 25% on Indian exports, 40% on Brazil, and Canada saw a jump from 25% up to 35%.
Wow, 35% on Canada.
Yeah. And on top of that, there's sort of a general 10% baseline tariff for most other trading partners. So it's broad.
And it sounds like the semiconductor industry is getting a massive push towards domestic production, almost like a forced reshoring effort.
Exactly. That's precisely the goal. There's a proposed 100% tariff on imported semiconductor chips.
100%.
Yep. But here's the key part. There's an exemption, but only for companies that manufacture or formally commit to manufacturing right here in the U.S.
So it's a direct incentive.
Oh, absolutely. A powerful one. And we're already seeing results, concrete examples. Apple's U.S. silicon supply chain, for instance, is apparently on track to produce over 19 billion chips domestically in 2025.
19 billion. That's something. Now, here's something I think is particularly significant for a lot of businesses listening. The suspension of the de minimis exemption. What does that actually mean day to day?
Okay, yeah, this is a really big policy shift. It takes effect August 29th, 2025, and it applies to all commercial shipments valued at $800 or less.
Those used to be duty-free, mostly,
Yeah.
right? For efficiency.
Correct. They typically entered the U.S. duty-free, which made e-commerce logistics, especially from places like China, very efficient and cost-effective. Now they'll be subject to tariffs, just like larger shipments.
And the impact.
Well, it's projected to hit logistics providers pretty hard. DHL, for example, anticipates its full-year operating profit could be trimmed by up to 3%.
Which sounds small, but
it translates to around $231 million just from this one change. It really puts into perspective, the razor-thin margins and the sheer volatility these guys navigate.
wow. So they're reacting already.
They have to. DHL has already cut its air freight capacity on that.
Okay, so moving beyond trade policy, these geopolitical tensions, they just keep influencing everything, which raises a big question. How are regulators trying to get a handle on illicit activities?
Yeah.
Especially in the maritime world, which can be pretty opaque.
Yeah, it's a huge challenge. If we step back a bit, the U.S. Treasury's Office of Foreign Assets Control, that's OFAC, they issued a new maritime sanctions advisory back in April 2025.
And what's new about it?
It significantly broadens the definition of what counts as deceptive shipping practices. So they're looking much closer at things like multiple ship-to-ship transfers.
That's where they move cargo between ships at sea, right, to hide its origin.
Precisely. And they're also cracking down on detecting these so-called zombie vessels.
Zombie vessels. Okay, explain that one.
These are ships that are operating using the IMO numbers, the unique identifiers of ships that have actually been scrapped. It's a way to mask the real identity, often used for sanctioned trade.
And Panama, which is obviously a massive player in global shipping, they seem to be really stepping up their game on this. That feels significant.
Hugely significant. The Panama Ship Registry is the world's second largest flag registry, so what they do matters. They started proceedings to cancel the registration of 17 vessels that were on the U.S. OFAC sanctions list.
Just 17? Or is that part of a trend?
Well, it follows 107 ships they deregistered back in March alone. So yes, it's part of a bigger effort.
Okay.
And they've also brought in new mandatory traceability for offshore STS transfers effective August 6th. Panamanian-flagged oil vessels now need to give 48 hours advance notice.
And they're tackling older ships, too.
Yes, just this month they announced a new age restriction. They won't allow new registrations for oil tankers or bulk carriers that are older than 15 years. It's clearly a move to sort of clean up their registry's reputation and reduce risk.
This sounds like a pretty strong, coordinated global push. But, given how persistent this problem of illicit shipping has been, what are the real challenges here? Is there a risk these measures just push the bad actors further into the shadows?
That's the critical question, isn't it? And others are joining in. Norway, for instance, starting August 11th, will require foreign-flagged tankers in its economic zone to disclose their insurance arrangements.
Aimed at the Russian shadow fleet.
Specifically aimed at them, yes. That fleet is seen as posing major environmental and safety risks due to potentially substandard vessels and insurance. But despite all these aggressive measures, the reality is the dark fleet, this hidden armada, it continues to grow.
How big are we talking?
Estimates put it around 1,900 ships globally, and a significant chunk, think 40% of tankers trading with Iran, 30% trading with Russia, are still using fraudulent registries.
So the economic incentives are just too strong.
Apparently so. The incentives for sanctions evasion remain very powerful, and this creates growing environmental risks, potential oil spills from poorly maintained ships, plus the whole long-term problem of having this parallel, unregulated global shipping system operating alongside the legitimate one.
And we can't forget the ongoing physical threats either, which just adds another layer of complexity and risk.
Absolutely right. Houthi militants in Yemen, they're continuing their pressure campaign. They just issued warnings to 64 different ship owners, accusing them of violating the Israeli blockade, and they're actively tracking ship movements. So this isn't a resolved issue. It's an ongoing, active threat that operators constantly have to factor in.
So what seems crucial here is that this escalating enforcement against the shadow fleet, combined with these persistent physical threats, it's fundamentally reshaping how companies assess maritime risk. Legitimate operators are being forced into adopting much more proactive, intelligence-led compliance strategies.
Exactly. And you have to wonder if this could further split the global shipping market, creating a sort of two-tiered system.
Right.
One transparent and legitimate, the other riskier and operating outside the rules.
Yeah, it's clear these policy shifts, these geopolitical events, they aren't happening in isolation. They create this powerful domino effect, right? Rippling through every single link of the supply chain. And sometimes those ripples create really surprising surges. What's an immediate example of that sort of cross-modal interdependency we saw just this week?
A prime example just happened. The July air cargo volume surge. We saw a 5% year-over-year increase, which sounds good on the surface.
But it wasn't organic growth.
Not really, no. It was primarily driven by companies front-loading shipments, rushing them in ahead of those big U.S. tariff rollouts that hit on August 7th.
So pulling demand forward.
Exactly. And this creates a kind of whiplash effect.
Yep.
Because they pulled all that demand forward, there's now a projected 20% decline in U.S. retailer imports expected for September through December. So you get this surge, then this void.
Which must make capacity planning incredibly difficult for logistics providers, wouldn't you say?
Extremely difficult. How do you plan resources when you have these artificial peaks and troughs driven by policy deadlines?
And thinking about ongoing impacts, what about the Red Sea crisis? It's not exactly new news, but it's surely still affecting global trade patterns.
Absolutely.
Yeah.
The long-term influence is definitely continuing. We're seeing it subtly bolster European imports from the Middle East, for example, as companies look for alternative routes or sources that avoid the Suez Canal passage.
Right.
And it just keeps reinforcing that strategic imperative for supply chain diversification. It's also creating more opportunities for these sea-air modal shifts.
Where goods go partway by ship, then switch to air.
Correct. To bypass the troubled Red Sea region while maybe not incurring the full cost of air freight for the entire journey. It's a compromise solution.
Okay, let's maybe zoom in on specific sectors now.
Yeah.
How did container shipping actually fare this past week amidst all these complex, sometimes contradictory dynamics?
Yeah, complex and paradoxical are good words for it this week. On one hand, you have U.S. retailers projecting those big import declines we just talked about because of the front loading. But then Maersk, one of the giants, actually revised its full-year profit forecast upward, citing resilient demand. So they're seeing some underlying strength somewhere.
Not everyone.
No, contrast that with CMA CGM, another major carrier. They reported a slide in their Q2 earnings, and they specifically blamed geopolitics and tariffs. So different impacts or maybe different reporting periods playing a role.
And what about rates?
Very mixed. Regional rates showed big disparities. For instance, India to the Mediterranean surged higher, mainly due to blank sailing ships skipping ports to manage capacity. But overall, east-west rates, the main trade lanes, are actually expected to decline by about 10% in the second half of the year.
Why is that?
Primarily oversupply of vessels, lots of new ships were ordered during the pandemic boom, and now they're hitting the water. But despite all this volatility, you still see strategic investments happening. Carriers are ordering new, modern ships and selling off older ones. They're still playing the long game.
And the ports themselves? Were they ready for all this shifting cargo, the surges?
Well, persistent congestion is still plaguing major North European hubs like Rotterdam and Antwerp. That leads to delays. It's a recurring bottleneck.
So the infrastructure struggles to keep up something.
It does. However, we are seeing significant long-term investments in port infrastructure and capacity expansion continuing globally. Like new gantry cranes just arrived at Melbourne's intermodal hub in Australia, and major terminal upgrades are happening at Jebel Ali Port in Dubai. So the long-term strategic vision for global trade infrastructure, that's still very much in motion.
Okay, shifting modes now to air cargo. After that tariff-driven surge in July, what's the general outlook? Is it all bad news, or are there any silver linings?
The outlook for the rest of 2025 is definitely being described as cloudy and turbulent. We already discussed the expected hit to DHL's profitability from the suspension of the U.S. minimis rule. And e-commerce demand, which has been such a key driver for air freight, is under increasing scrutiny and pressure. IATA, the International Air Transport Association, they even revised their 2025 outlook downwards recently. They're now predicting a 4.7% contraction in global air cargo turnover for the year.
Ouch, a contraction. But is it universally bad?
Not entirely. There are pronounced regional differences. Asia-Pacific is actually leading growth, up 8.3% year-to-date.
Yeah.
And the specific trade lane between Asia-Pacific and the Middle East Africa, that's APAC-ISMEA, is outperforming all others, up a remarkable 19% year-to-date.
Wow. So some corridors are booming.
Exactly. And major players like the DHL Group, despite the headwinds, are maintaining profits. They're doing it through efficiency improvements and really active capacity adjustments, like DHL Express, cutting 7% of its China-U.S. air freight capacity to better match the expected demand.
Are we seeing changes in the aircraft being used too?
Yes, that's interesting. We're seeing some freighter order cancellations, like for the big Airbus A350 freighter. And the trend seems to be that the cargo capacity available in the bellies of passenger planes, what they call wide-body belly capacity, that's actually growing faster now than the capacity added by dedicated, purpose-built freighter aircraft.
Huh. So more cargo flying on passenger routes.
Seems to be the case. One definite positive note for the airlines, though. Jet fuel costs dropped substantially. They were down 18.8% year over year in May, which really helps their operating margins.
Okay, let's shift gears again, down to ground-level road freight. Given all these global shifts trickling down, how's the trucking market holding up?
Well, the U.S. trucking market generally experienced a kind of stalled performance in the first half of 2025. We're seeing growing regional differences in demand and freight rates, and, worryingly, an increasing number of carrier revocations.
Meaning more trucking companies are going out of business.
Exactly. The pressure is definitely on, especially for smaller operators. Regulatory changes are also having an impact, like the new English language proficiency rule for truck drivers taking effect. There's also ongoing debate and advocacy about including teen truckers in interstate commerce to ease driver shortages.
But also potential constraints.
Right, while at the same time, immigration crackdowns could potentially further constrain capacity by limiting the available labor pool. It's a real push and pull.
Interesting dynamic. Any relief for the industry?
Yes, actually. On the positive side, Congress just approved a bill with some major tax breaks aimed specifically at the trucking industry. This includes making the 20% qualified business income, or QBI, deduction permanent for them.
Which lets businesses deduct a chunk of their income.
Correct. And also 100% bonus depreciation, allowing them to deduct the full cost of new assets, like trucks, in the year they buy them. So significant financial incentives are being deployed, presumably to help stabilize the sector amidst the pressures.
Okay, and what about the very final leg of the journey? Parcel and last-mile delivery. How are the big players like UPS and FedEx adapting to everything?
They're definitely in restructuring mode. UPS, for instance, extended the deadline for its buyout offer to drivers, but it apparently saw pretty low interest and faced opposition from the Teamsters union. So that highlights the ongoing tension in workforce management.
And FedEx.
Meanwhile, FedEx announced nearly 500 job terminations. So cost-cutting and restructuring are clearly priorities.
Any changes affecting shippers directly?
Yes, a big one from UPS. They're aligning their pricing structure more closely with FedEx by changing how they calculate dimensional weight.
Dim weight. That's about package density, not just weight.
Exactly. And the change is that UPS will now round up all fractional package dimensions, length, width, height, to the nearest whole inch starting August 18th. Previously, they might have rounded differently. This seemingly small change could significantly increase calculated dim weight and therefore shipping costs for many shippers. It fundamentally changes how they need to think about packing.
So more cost pressure there. Anyone else?
Yep, the U.S. Postal Service is also seeking approval for a demand surcharge for holiday deliveries again this year, indicating that peak season shipping is just going to keep getting more expensive. And we're seeing market consolidation continue too, like InPost, a European locker company acquiring a Spanish delivery provider. It's all about scale and efficiency.
Right. And finally, just briefly, let's touch on rail transport. Any big news there, particularly for passengers maybe?
Yes, some positive news on the passenger front. Amtrak's much-anticipated next-gen Acela trains are scheduled to finally debut on August 28, 2025.
Ah, the new high-speed trains for the Northeast Corridor.
That's them. They promise increased capacity and expanded schedules, so that should be a significant upgrade for travelers there. And on the urban rail side in D.C., WMETA is undertaking major construction on its Green Line throughout most of August, from the 2nd to the 31st.
Causing disruption.
Yes, temporary station closures, and the need for free shuttle buses. But it highlights that ongoing vital maintenance and upgrade work that has to happen in our urban transit networks, even if it causes some short-term pain.
Okay, now, here's where we pivot to something that feels truly transformative, cutting across all these sectors we've discussed. Technology.
Yeah.
It's clearly not just a supporting player anymore. It feels like it's becoming indispensable. Let's talk about the rapid acceleration of AI and automation.
Yeah, this is huge, and it raises a really important question. How fundamentally are these technologies transforming logistics? Not just making things incrementally better, but really changing the game.
So what are some concrete examples from this past week?
Okay, in autonomous trucking, we saw Plus AI, a major player in self-driving trucks, teaming up with Goodyear, the tire company. They're working to integrate intelligent tire technology directly into autonomous trucks.
Smart tires. What does that do?
It provides real-time data on tire pressure, temperature, wear, and tear, directly feeding into the truck's autonomous system for enhanced safety and efficiency. Plus, AI is targeting a commercial launch for this integrated system in 2027. So it's not just about the truck driving itself, it's about making the whole system smarter right down to the tires.
Interesting. Any other autonomous trucking developments?
Yeah, another company, Wawabi, introduced a pretty innovative mixed reality testing system for autonomous truck safety. It allows them to simulate complex scenarios in a highly realistic virtual environment, really pushing the boundaries of how you validate these systems safely before they hit the road.
And shifting from the road to the warehouse, there was a major milestone for robotics, wasn't there?
A huge one. Geek plus Ness, which is a global leader in warehouse robotics, specifically autonomous mobile robots, or AMRs.
The ones that move goods around warehouses.
Exactly. They listed on the Hong Kong Stock Exchange on July 9th, 2025, with a valuation of $2.82 billion.
Wow. What's the significance of that?
It makes Geek plus the first publicly traded AMR warehouse robot company globally. This signals really strong investor confidence in the future of warehouse automation, even though the reports noted the company is, quote, still burning cash.
So investors are betting big on future growth.
Absolutely. And Geek Plus itself has ambitious plans. They intend to double their robot deployment count to 20,000 units by 2027. That's aggressive expansion.
So pulling back a bit, what does this tell us about AI specifically within logistics? What's the real impact beyond the hype in the headlines?
Well, the numbers are pretty staggering. The global market for AI in logistics specifically reached $20.8 billion in 2025.
$20.8 billion.
Yeah, and that represents a compound annual growth rate, a CAGR, of 45.6% just since 2020. That's not just growth, that's an explosion.
And adoption rates.
67%. Two-thirds of supply chain executives reported that they had fully or partially automated key processes using AI by 2025, so it's widespread.
And is it delivering tangible value?
Absolutely. Across the entire supply chain, we're talking predictive maintenance for vehicles and equipment, dynamic route optimization that adjusts in real time, much more accurate demand forecasting. The specific benefits being reported include things like a 30% reduction in forecast error rates.
Which is huge for inventory planning.
Exactly. And linked to that, a 15% decrease in the required safety stock levels companies need to hold. Just that inventory reduction is estimated to lead to about $300 million in annual savings in inventory holding costs across the board.
300 million.
Yeah.
Just from holding less stock safely.
Right. And what's truly remarkable here, I think, isn't just the efficiency gains, although they're impressive. It's the shift you mentioned earlier, logistics moving from being seen primarily as a cost center.
To a strategic competitive weapon.
Precisely. That $300 million in savings isn't just cost cutting on a spreadsheet. It's capital that gets unlocked. It can be reinvested in innovation and growth. It's this silent, powerful enabler for businesses that are really embracing AI.
So if we connect this to the bigger picture for you, our listener, this isn't just about doing things faster or cheaper. It's a fundamental paradigm shift, isn't it? Moving from reactive supply chain management, dealing with problems as they arise, to proactive management, using AI to anticipate and prevent issues. It really makes logistics a strategic differentiator.
Couldn't agree more.
But of course, technology isn't the whole story. We touched on it earlier. But labor dynamics, the human element, that remains a persistent and often really challenging factor in all this.
Definitely. You see the tension playing out clearly. On one side, you have corporate cost optimization strategies, like that UPS buyout offer that got a lukewarm reception in union opposition, or FedEx's job terminations. It highlights the ongoing challenge. How do you integrate all this new technology while managing your existing human workforce fairly and effectively?
And it's not just about truckers or warehouse workers, right?
No, absolutely not.
Yeah.
A new report just came out highlighting the continuing widespread absence of shore leave for the world's seafarers.
So crews stuck on ships for months on end.
Yes. Pointing to ongoing serious challenges in crew welfare. That's a vital but often completely overlooked human element in the whole global shipping equation. These are real people keeping things moving.
Yeah. These really are the human realities that accompany all these massive technological advancements and policy shifts we've been talking about in global transportation. It forces businesses, or should force them, to think very carefully about human capital management alongside the tech investments. It's a complex balance, to say the least.
It truly is.
Wow. What a fascinating deep dive this has been. We've really unpacked a lot. The complex interplay of trade protectionism, literally reshaping supply chains, the persistent geopolitical instability, creating brand new kinds of risks, and then this explosive growth of AI and automation transforming how goods physically move.
Yeah, we've seen how volatility seems to be becoming the new normal, really demanding extreme agility from everyone in capacity management. And also how, despite all the short-term fluctuations and immediate pressures, those crucial long-term strategic infrastructure investments in ports, in rail, in technology, they're continuing. They're laying the groundwork for future capabilities.
So for you, our well-informed listener, maybe here's a final thought to mull over, one that kind of builds on everything we've discussed today. Given the persistent growth of that shattering operating outside the rules, and the simultaneous rapid acceleration of AI and automation within the legitimate logistics world, are we ultimately going to see two distinct global supply chains emerge? One that's highly transparent, highly efficient, leveraging cutting-edge technology.
And another one operating in the shadows, perhaps equally sophisticated in its own way, but fueled by ingenuity dedicated to illicit purposes, a sort of high-tech versus high-craft underground system.
Exactly.
Yeah.
Something to think about.